Hello and welcome to today's video. In this video, we'll discuss how your behavior affects your investing decision and affects the call that you take in the market. और ये रहा आपका सवाल आपके कंप्यूटर स्क्रीन पर. Given a choice on investment, a product which has a 50-50 possibility with high risk but equally high returns versus low risk but equally low returns, what will you choose? आप क्या choose करेंगे? Your options are high risk, high returns. Option B, low risk, low returns. Time starts now. Sir, I'll choose the low risk, low return option, please. Lock कर दीजिए. Okay, computer जी. Lock B, low risk, low return investment option. Ladies and gentlemen, before we move on with the game, let's pause and let's try and understand why he chose what he chose. To understand this, we first need to understand cognitive psychology. All investors who thrive in today's market, we do this with the help of cognitive investing. Why? Because it offers a focused perspective. Because it is based on ideas and perception that has been in the market for a very, very long time. It's a time and tested thing, unaffected by the state of the market. Have we ever wondered how the financial ecosystem works versus how it should work? How people want to operate it versus how it's understood correctly or incorrectly. See, if you're a cognitive investor, you can ignore the media barrage, you can ignore the news, you can ignore the updates that are coming in, you can ignore the media, you can ignore the astrology tips, the attention-grabbing headlines from the news channels. You can ignore all of these. Unbelievable, but it's true. If you can do this, you'll have a peaceful investing life. A life with less tensions, a life which is less chaotic. You will know that your financial life is under control. So in situations like this, what is the correct decision? What if somebody is asked, what would you choose? Would you choose an investment decision which has a 50% chance of getting a very high profit but an equally high risk, versus an investment which gives lower profit but with a substantially lower amount of risk? What would you choose? The chances are most of us will prefer to choose the option number 2, which has got a very low risk. But if you see the mathematical expectation value of the first investment return, it is higher than the second one. Isn't that a more rational choice to choose the first option over option number 2? Isn't it rational to go for a high return investment? Yes, it is. But what happens actually is most of us would choose option number 2, which goes to tell us how almost always your emotion would ride over your rational thinking in the market. But why does it happen? Is there anything that can be done to counter this? To counter the emotional influence on investing decision? See, we humans, we are driven by emotions all throughout our life, even in the investing world. And it drives our behavior in investing too. And that's what makes our investment portfolio look and shape and look like what it is today. Emotions are so powerful that even if somebody warns you that there is a trap, it's very, very unlikely that you would listen to the person. Probably you will find that trap the hard way. Opposed to the conventional finance theory, behavioral finance contends that investors take biased decisions and judgments. Why do they do that? Because investors, they systematically deviate from full rational behavior and thinking. And that is what makes market prices deviate systematically from their rational values. These errors are, however, not the result of an ignorance. Rather, they are results of typical strategies that the human intelligence has dealt with over the period of time and has learned to evolve and deal with the complex environment in investing world. Do we know what are the 2 traits in today's investing world? The first one would be we are hardwired to short-term profits. We find short-term profits are very attractive, very, very luring. When we make short-term profits, they tend to make us confident, stimulated. We feel good about ourselves. Option number 2, we are hardwired to the herd mentality. See, I understand it's very, very difficult to go against everyone else. When everyone is moving in one direction, you feel there is definitely a problem. That's the reason why people are moving in this direction. That's the reason why people are behaving the way they are behaving right now. But fortunately, we humans have an ability, the ability to self-control the force of our emotion, our emotional reaction. So the more we use it, the lesser we'll have to deal with it the next time. And at all times when self-control is actually required. So we see the problem with emotion is that we cannot control ourselves. But without emotion, we cannot take a decision as well. We run for short-term profits. We tend to feel good. We run after them. We think of them as our alternate income, a second income. And at the same time, we also cannot go beyond and against the people. We run with the herd. If you try to control this, you will lose your ability to exercise self-control. This happens when you see a share which has gone up very high. You have made profits in it. It's almost always tempting to feel like, it's time for you to book the profits from it. It's time that you cash out on the gains that you have already acquired on that transaction. Some of you, we also fall in love with the stock. We tend to feel that we don't believe that this particular stock can be off fashion. We don't believe that this particular industry can be off fashion. But these behavioral patterns are implicit and absolute, and hence they are mostly overlooked. They are unknown, and hence they are not discussed as much. But that is the problem. Majority of us are driven by emotions while investing. But the problem is they don't know that they are affected by their emotions. When you ask them, they'll say, no, we are not affected by anything. We only go by what's happening in the market. That's what their answer is. But in actual, when they take an action based on their emotions. You see, you don't believe that you're taking a trade with your emotion. So for you, there is no problem. You tend to believe that there is no problem at all. And the problem is when we have too high opinions about ourselves, we fail to realize that we are not immune to the problems in the market. We are not immune to the mistakes that others make in the market. We don't realize that we may fall, or we might have already fallen in one of those behavioral traps. We don't realize it happening with us. Traps? What traps? So we start giving proofs and testaments that agree to our viewpoint with more credibility while discounting those that do not. Herding. We often run behind a mass of people, believing the person leading this run knows more than I do. The person in front, he knows more than almost many of us here. That's the reason why so many people are following him. The trap is the fear of doing the wrong thing. What if you take a different decision from that of the herd and you are wrong? You are afraid of this. The trap of holding on to a wrong security, a wrong share for a very, very long time, thinking that it will bounce back and give you the profits that you anticipated from that transaction. But you don't realize that it's fundamentally it has become a very weak stock now. The possibility of it coming back or rebounding is very, very less. The trap of selling off a winning stock too early because you are impatient. You just want to book the profits. You have made a handsome profit on that transaction. You just want to book it. Also, it might be because you now fear that it might just take a U-turn and it'll plunge down. So before it does, let me get out and book my profits. See, a human mind is not optimized for investing and taking investment decisions. We all suffer from heuristics and biases. But the problem is, we tend to believe that we are immune to all of these, which is actually not. We know we all are humans. We are not immune to mistakes. Unfortunately, many of which can be categorized under these 4 different categories. The most common pitfalls in the market: heuristic, self-deception, emotion, and social interaction. If you want to know about heuristics and bias, there is a video in my playlist. I'll try and give it in the I button. You can go and have a look at it. About the pitfalls, I'll not be going deep into the pitfalls in this video, but I'll give you some points which can help you identify the pitfalls. At least you can be aware of them. Focus on facts and do not focus on stories or news or whatever it is that is presented to you. More information doesn't necessarily help you. It might confuse you a lot more than those who doesn't have more information. Don't be biased on your personal experiences. Don't blame bad luck for your mistakes. Look for the proper solution to it. Something doesn't necessarily become valuable just because you now own it. Don't just simply believe the information that is coming to you. Scrutinize it, go deep into it, find out the source from where it came to you, find out the authenticity. Look at the authenticity of the source that has provided you with that information. Number 7, you know less than you think you know it. Absolutely true. So to believe that you have known it all is a dead trap. Number 8, validate and respect the information that challenges you. Try and find out why that information is challenging your belief system, your analysis in the market. Try and understand why it's happening, and then probably you'll be able to find out the reason. Number 9, judge by statistics and not by how they appear in front of you. Judge an information by its statistics. Number 10, sell off your losing position and ride on the winners. Don't just hold on to a stock thinking that it will rebound back. It doesn't happen always. Yeah, if it's fundamentally strong, you can do that, but just relying on it that it is good doesn't make it good. See, as a trader, you should isolate yourself from the effects of outside influences, as they can divert you from executing a well-perceived plan for your investment. Even a well-experienced investor can make the same mistakes. They can be crippled by this counterproductive thinking, take poor decisions, and make trading errors. So one thing becomes very valuable in the investing rules, and applying it very systematically, and that is, the rules are what you set for yourself, for your style of investing. But the fact is, only rules cannot help you, because if it were, then machines could perform much better than humans. We can feed in the rules into a machine and ask it to perform and make the transactions. It cannot do it because it simply cannot judge. So how do you break this? You should break this by using your judgment and using the rules. Combine them in such a way that they enhance and emphasize the qualities of each other in a more prominent way. Use your judgment to understand the dynamics of the market movement, and use the rules to assess the numbers. So it becomes evident that your portfolio performs better when it is exposed to multi-directional challenges. And mostly, the returns are far, far better off. The returns are far better off when a team of people handles your portfolio than you handling your portfolio yourself. So together with you and your investing team, a winning mindset becomes the most essential ingredient in making a successful portfolio and a successful trading decision. And that is the most essential aspect in investing. That's all for today. Have a nice day. Like and subscribe this video, and I'll bring in more concepts about investing and behavioral finance all in this channel. Thanks for watching. Have a nice day. Till then, SG signing off. Goodbye.